35. Guys, that is a massive number in the corporate world. We're talking about 35 consecutive years of dividend increases. It's an incredibly rare distinction among publicly listed companies, and it immediately establishes this undeniable financial resilience. Welcome to today's Explainer, where we're going to unpack exactly how a company achieves that kind of multi-decade streak, and more importantly, how they're keeping it alive today. Today, we're unpacking the Q1 2026 earnings of a truly fascinating B2B rental machine, McGrath RentCorp. Now, they might not make the flashy consumer headlines, but they are absolutely a critical backbone to industries ranging from education all the way to tech. We're going to look under the hood of their financial engine to see exactly how they navigated the start of 2026. Okay, let's look at the roadmap. We'll cover the McGrath RentCorp engine, their Q1 2026 financial results, how data centers are driving segment growth, capital allocation and buybacks, and finally, the competitive landscape.
So, jumping right into Section 1, the McGrath RentCorp engine and their diversified B2B rental model. You know, to understand how a company actually manages to raise dividends for 35 years straight, you really have to know what they're renting out, right? And to who? Well, they have 4 key segments. First up is mobile modular. Think relocatable modular buildings for classrooms and office space. Then, portable storage containers. Third is TRS RentElco, which rents out electronic test equipment for general purpose and communications needs. And finally, Enviroplex, their California-based classroom manufacturing business. It's like a giant puzzle, and this diverse mix is literally their shield. When one sector, say commercial construction, slows down, another one steps right up. It's a beautifully diversified model that protects their revenue streams from volatile macro shifts.
Moving right along to Section 2, Q1 2026 financial results and steady top-line growth.
Now, what's really interesting here, when you look at the raw data on their condensed income statement, is the bottom line. Net income actually dipped slightly. They brought in $27 million, or $1.10 per diluted share for the first quarter of 2026. That's down just a hair from $28.2 million in the same quarter of 2025. But, and here's the kicker, if you look up at the top line, overall revenues actually climbed.
To put that into perspective, despite some admittedly challenging market conditions like higher costs for equipment preparation, top-line total revenues successfully grew by 2%. They bumped up from $195.4 million in Q1 of 25 to $198.5 million in Q1 of 26. And rental operations specifically, those saw a really solid 5% increase.
Which brings us to Section 3, Data Centers Drive Segment Growth. It's truly a tale of two markets. Because, you see, that overall 2% growth we just talked about, it's kind of just an average, and it hides some massive shifts happening right beneath the surface. It brilliantly illustrates this tale of two markets. On one side, you've got their tech-adjacent TRS RentElco segment. They are riding some massive tailwinds from data center buildouts. We're talking phenomenal 13% rental growth and utilization rates hitting 68%. Management even noted that's super high for this business historically. But then, on the flip side, you have the portable storage division facing some real headwinds. With non-residential and commercial construction project activity staying soft, they just squeeze out a flat 1% growth. Basically, the booming tech segment perfectly counterbalanced the sluggish construction segment.
And their president and CEO, Phil Hawkins, hit the nail on the head during their earnings call. He pointed out that this demand isn't necessarily a brand new type of work, but rather a massive volume increase. The surge in megaprojects, specifically building out all these new data centers, is absolutely supercharging the demand for their electronic test equipment. It's a total volume play, and McGrath was perfectly positioned to capture it.
All right, Section 4. Capital allocation and buybacks, and how they are rewarding shareholders.
Because look, generating cash is one thing, right? But how a company actually uses that cash is what truly builds long-term wealth. And this statement from CFO Keith E. Pratt is a major signal to the market. He highlighted that the executive team authorized their very first share buybacks in 6 years, actually since the COVID era back in 2020. They looked at their lower leverage, the extreme health of the business, and some pretty attractive equity market levels in March 2026, and just decided, yeah, it's time to pull the trigger.
So, the crucial point here is the actual scale of this. They confidently deployed roughly $11.9 million to repurchase 113,591 shares. The average price? About $104.44 a share. Oh, and they still have over 1.8 million shares authorized for future repurchases under their current plan. That's a lot of dry powder.
Now, this buyback isn't just some random move. It's part of a highly disciplined, three-pronged capital allocation framework. Step 1 is always organic fleet investment, putting more capital to work in that high-demand TRS segment we talked about. Step 2 is strategic M&A. For example, right after the quarter closed on April 1st, they locked in an $11.4 million acquisition of a Midwest modular provider. And finally, Step 3 is returning all that excess cash to shareholders through those steadily increasing dividends and, of course, the share buybacks.
Let's move on to our final section, Section 5, the competitive landscape and how MGRC stacks up.
If you take a look at how they compare against peers like Cintas and Copart, it's pretty revealing. McGrath, trading under the ticker MGRC, offers a much more affordable valuation. They're sitting at a price-to-earnings ratio of 17.68. Compare that to Copart at nearly 21 or Cintas at a whopping 48.89. Yet, despite being priced way more affordably, McGrath is still maintaining highly respectable double-digit net margins at 16.38%. So, they're staying highly competitive when it comes to generating actual bottom-line profit from their revenues.
Which brings us to the ultimate question as we wrap up today's explainer. With the construction side of the business remaining a bit soft, will McGrath's massive tailwinds from data centers and that strategic pivot toward high-utilization tech rentals be enough to sustain this incredible dividend streak into 2027? Will we see year 36? It's a totally fascinating dynamic between the old economy of commercial construction and the new economy of tech infrastructure, all playing out on one single balance sheet. Thanks for learning with us today, and we'll see you on the next explainer.